Good morning, one and all present here. My name is Rishab, and today we will be presenting on the topic of multi-factor asset pricing model, also known as APT arbitrage pricing theory. This model helps us understand different economic factors that influence the asset returns. Next slide. So to begin, let's understand arbitrage. Arbitrage is a practice of buying an asset at a lower price in one market and simultaneously selling it at a higher price in another market. The mechanism is simple: buy low in market A and then sell high in market B. Since there is no investment risk involved, it results in what we call a risk-free profit concept. Next step. So now let's see the definition and essence of APT. First, APT is a multi-factor model, meaning returns are influenced by multiple systematic factors like inflation, interest rate, and GDP growth. Second, it assumes a linear relationship stock price return that can be expressed by these functions of these factors. Third, it is based on arbitrage logic and law of one price, which states that the asset which with the same risk should generate the same returns. If not, the arbitrage opportunity will arise and quickly correct the prices. Next slide. Now let's see the concept of arbitrage. To understand this better, consider an example. If a stock price is at 100 rupees at market A and 105 in market B, the investor can buy it at 100 and sell it at 105, making a 5 rupees profit without risk. APT assumes that such opportunities do not last long, as the market forces quickly eliminate them. This ensures the price remains fair, aligned with underlying risk factors. So overall, APT approves a more flexible and realistic way of understanding asset pricing and considering multiple economic influences that rely on arbitrage to maintain market efficiency. Thank you.
Next slide. Next slide. Yeah. So I am Manasij and I will go with point number 5, that is risk-free rate and factor risk premium. So basically, risk-free rate is where the baseline return has no risk, and this usually comes from government securities and treasury bills. And this serves as a foundation for the APT calculation. So in factor risk premium, there's extra return for the investor that the investor demands for the exposure to funds. So this means that each factor has its own premium and the stock responds differently depending on their beta sensitivity. And we can use this to actually get to know about the risk premium factors. Going on the 6th point, that is systematic risk. Systematic risk is a risk that affects the entire market or economy, not just an individual firm. Examples are inflation spikes, recessions, monetary policy changes, geopolitical shocks. So going to the next slide. Yeah, so APT versus CAPM. So APT versus CAPM, the factors that affect APT are multiple, and the factors that affect CAPM are very single, that is only the market. And then going on to flexibility, APT is flexible, whereas CAPM is not also very flexible. Then going to realism, APT is very realistic, and CAPM is not as realistic as APT. And then the risk type, APT has multiple risk factors as it has multiple factors that affect its price. And as CAPM has only a market that is affecting its price, the risk type is also just the market. And now going to the 8th point, the application of APT. So stock valuation helps estimate fair value by comparing expected and actual return. So we construct a portfolio on these guidelines and using this to our advantage as per our goals. Then there is risk analysis, where we identify exposure to inflation, interest rates, and GDP growth. Then there's performance measurement, where we evaluate our portfolio on the basis of what factors, risk that we have taken, and then we make an investment decision on whether the stock is overvalued or undervalued, and how much or whether should we or should we not invest in it. So the forward will be continued by Deep Karotra.
Hello, good morning, everyone. Good morning, everyone. So I'll be continuing for the ninth point, that is assumptions of arbitrage, of the arbitrage pricing theory, or APT. Financial markets are reasonably efficient. Investors are rational and prefer higher return for a given level of risk. Asset returns are influenced by multiple systematic risk factors. No arbitrage opportunities exist in the long run. Investors can borrow and lend at the risk-free rate. Also, the last point considers of the idiosyncratic or the unsystematic risk can also be diversified away. Next slide. The next point is about the advantages of the arbitrage pricing theory. What are the advantages? Here are the considers multiple sources of risk, not just the market risk. It is more flexible, realistic than CAPN. It does not require a market portfolio, useful for a portfolio diversification and risk management, and widely applied by an institutional investors. But on the other hand, the 11th point is here the limitations of the APT or the arbitrage pricing theory are as follows. The first one is the identification of factors is difficult. Model does not specify the number or the nature of the factors, requires large data and complex calculations. It also assumes that the markets are efficient, which may not always hold true. And lastly, it is the less suitable for individual or the small investors. The further will be continued by Kavya.
So now I'm going to explain about. So now I am going to explain about the uses of APT in portfolio management and risk management. This means investors try to manage their money in a smart way so they can reduce risk and earn better returns. Diversify investments. Money is invested in different types of companies or assets so that one a loss in a specific area can be balanced by a profit in another area. Check in economic risk. Uh, Second, economic risk. Investors study factors like inflation, interest rate, economic growth because these factors affect returns. Reduces systematic risk. Systematic risk means market-wide risk that affects many investments together, such as inflation, recession, or proper portfolio management to reduce its impact. For example, if inflation is rising, prices of goods rise. Some companies earn more profit during inflation, like oil, energy, etc. Investor may invest in such companies to protect their money from inflation risk. Now let us see the formula for APT. Risk-free return plus beta 1 plus risk premium factor 1 plus beta 2 plus risk premium factor 2. Now let us see the practical numerical example of APT. Here is an example question. If an investor wants to calculate expected return of a stock using APT, the given is risk-free rate is 5%, inflation risk is 3%, interest rate premium is 2%, and uh, beta for inflation B1 is 1.5 and beta for interest rate B2 is 0.5. So here's a formula of RF plus B1 into RP1 plus B2 plus RP2. Now let us let us multiply B1 plus B1 into RP1. So 1.5 into 3 gives us 4.5, and B2 into RP2 gives 0.5 into 2, which is 1%. Now let's add the risk-free rate of 4.5 plus 1 plus 5%. So the answer is 10.5. It is the APT while the calculations of APT shows the expected return is 10.5 and the market is return is 8%. Conclusion: since the expected return is more than the actual return, the stock is undervalued and investor may buy to earn suitable profit. Thank you.